Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
We open today with a paradox, really, at the heart of the digital infrastructure sector, CleanSpark. It closes the calendar year 2025 with what can only be described as elite operational metrics. We're talking a verified operational hash rate of 50.0 exahashes per second, record annual revenues of $766.3 million. I mean, by almost every measure of industrial execution, they are leading the pack. And yet, their stock is just fiercely suppressed.
And that suppression isn't just a feeling, it's quantified in a way you almost never see with a successful company on the NASDAQ. I mean, we're talking about a staggering short interest of around 81.22 million shares. That figure is 32.91% of the total float. It's one of the most heavily shorted stocks on the entire exchange. This isn't just, a few bears making a wager. It's a defining structural feature of this stock.
Which brings us right to our central question. Is this profound disconnect, this suppressed valuation, is it a reflection of genuine, maybe unacknowledged fundamental flaws and governance risks? Or is it something else? A mechanical anomaly, a function of financial engineering that's just masking deep underlying value? My position is that the operational superiority, driven by their best-in-class 16.07 joules per terahash efficiency, will ultimately win out. The stock is significantly undervalued because that industrial moat is just too deep to ignore.
See, I come at it from a completely different angle. While the operational story is compelling, I agree. The financial architecture, specifically the overhang from that $1.15 billion convertible note, and the dilution fatigue in the market, it fundamentally justifies the discount. I believe the stock is caught in a structural trap, and for now, finance is going to outweigh physics.
Well, my core thesis really centers on the fact that CleanSpark is the premier operational executor in a very capital-intensive sector, and the market is just completely failing to price this in. The single most critical metric, the real moat here, is their fleet efficiency of 16.07 joules per terahash.
And we should probably pause on that number, because 16.07 JTH gets thrown around a lot, but its real impact needs some context.
Absolutely. To put it in perspective, the industry average for a large-scale miner is somewhere in the range of, 20 to 25 JTH. So this isn't a small difference. That efficiency gap translates directly into a 20 to 30% lower electricity cost for every single Bitcoin they mined.
Which is a crucial hedge.
It's more than a hedge. It's the ultimate survival buffer, especially after the 2024 halving, where less efficient miners are going to be mining at or even below their cost of production. CleanSpark's lower power cost secures a really robust margin. It keeps them profitable. And on top of that, hitting 50 EHs puts them in the top global tier. They proved it by mining 622 Bitcoin in December 2025 alone.
The execution on the mining side is, it's undeniable.
But the scarcest asset, the real gem, is the power infrastructure underneath it all. 1.55 gigawatts under contract, with 808 megawatts already being used. In the current U.S. grid environment, getting new substations approved and built takes 3 to 5 years? This power portfolio is a practically irreplaceable strategic asset, and it gives them this massive runway for growth and, crucially, the optionality for an AI pivot. And it's being valued like it's just another commodity.
Okay, I accept the premise of operational excellence, but let me introduce the counterargument, which is far more sophisticated, I think. The stock is trapped in what I'd call a valuation air pocket, and that pocket is driven by institutional mechanics that are, they're largely indifferent to your operational narratives. The primary culprit here is the $1.15 billion zero-coupon convertible note they issued in late 2025.
The very debt that funded the growth you just acknowledged.
Correct. But the mechanism itself dictates mechanical shorting. It's a classic convertible arbitrage play. For anyone who isn't in derivatives, what happens is funds buy the low-risk convertible debt, which gives them a fixed yield. Now, to lock in that yield and hedge against the stock price moving around, the goal is to be delta neutral. They simultaneously short the stock. They are betting on the bond's yield, not on the company failing. And this explains why the stock doesn't move on good news. When CleanSpark hits a milestone, like 50 EHS, the arbitrageurs often have to short more stock to rebalance their hedge. So good news literally triggers more selling. On top of that, the market is deeply skeptical about their AI execution. JP Morgan downgraded them precisely because they see CleanSpark as late to the game compared to, say, a peer like Iron, who already has binding contracts with hyperscalers.
Bears argue that retrofitting these rural mining sites for HPC is expensive and, they might not even have the fiber diversity needed.
All right, let's start with the nature of that short interest because this is where we really diverge. You call it a structural feature, and I agree, it's mechanical. But I think you're really downplaying the sheer volatility that this feature introduces.
You see volatility? I see evidence of a non-directional trade. Just look at the cost to maintain these shorts. The borrow fee rate is incredibly low, between 0.36 and 0.49%. If this were a fundamental bet against the company's survival, if people thought CleanSpark was truly broken, the cost to borrow shares would be through the roof. The low fee proves the shares are easy to find, which just confirms the arbitrage theory. It's yield-seeking, not a bet on distress.
I'll concede the point on the borrow fee. The initial motivation isn't to stress. But when that mechanical shorting gets to the scale of 32.91% of the float, it stops being a passive hedge and it becomes an explosive powder keg. While the reason for the short is mechanical, the risk is now purely gamma-driven.
That's a highly complex dynamic. Can you elaborate on that gamma risk?
Sure. We have massive open interest in call options, especially for January 2026 and 2027. The market makers who sold those calls are now short gamma. So if the stock price suddenly rallies, let's say they announce a major AI contract, those market makers are forced to buy stock aggressively and quickly to stay hedged. When you combine that buying with the arbitrageurs who also have to cover, the buying pressure would just consume all available liquidity for nearly a full trading week. The days to cover ratio confirms it. The mechanical shorts have created this massive, unstable vulnerability that's just waiting for a catalyst.
I understand the potential for a catastrophic move, but the trigger is still missing. And until that trigger is pulled, the valuation is grounded in today's reality. Let's pivot to that valuation gap, because this is where the market is really separating potential from actual execution.
I think the key asset here is the 1.45 GW power portfolio. The market is treating CleanSpark like a pure-play commodity miner, giving it a mining multiple maybe 2 to 4 times revenue. My position is that this power capacity deserves a data center multiple, which is closer to 15 to 20 times revenue. Power is the ultimate bottleneck for AI infrastructure today.
But potential doesn't pay the bills, right? The market is waiting for tangible AI revenue. I mean, let's challenge this idea that the power is a strategic asset for HPC. It's one thing to have megawatts in Georgia. It's another to have the ultra-low latency fiber and the infrastructure density to support 100 kilowatt per rack AI clusters. The bears argue that until CleanSpark proves they can deploy that specific infrastructure and land those high-margin hyperscaler contracts, the assets are rightly valued by their current use, which is mining.
But look at the financial performance despite that low multiple. The company generated $365 million in GAAP net income. That validates the low-cost operational model. The operational reality provides a floor that the current valuation just seems to be ignoring. And that power portfolio, that is the option value embedded in the stock. If a hyperscaler wanted to build 500 megawatts of new capacity today, they couldn't get it online for years. CleanSpark already has it. That scarcity deserves a premium right now, not just after a contract is signed.
I'm not convinced, especially when you look at their peers. The market is pointing directly to Iren. They have a similar hash rate, but they command a premium valuation. Why? Because they successfully executed the AI pivot. They have the binding contracts. CleanSpark is stuck in the potential category. Until they secure those hyperscaler agreements and prove they've solved the technical hurdles, fiber routing, thermal management for GPUs, they will rightly trade as an efficient, but ultimately just a commodity miner. The market rewards execution, not just available land and power.
Which brings us right to the capital strategy, the very source of this short pressure. That $1.15 billion note is precisely the war chest they need to fund the AI pivot and make the upgrades you're demanding. You have to see this as strategic capital stewardship.
I see it differently. I see it as a massive, visible overhang. Management says it delays dilution, but the bearish view is that it's just delayed dilution. That debt has to be paid back or converted eventually, which will massively increase the share float down the road. And then there's the governance noise, the sudden resignation of the former CEO, Zach Bradford, and the return of co-founder Matt Schultz. His background is in finance and capital formation, so the market sees that as a pivot back toward financial engineering. Add in optically poor insider sales, and discretionary funds see a narrative of misalignment and risk that they're happy to bet against.
I see why you raise those points, but I disagree with the interpretation. I don't see it as a negative pivot. I see the capital structure as highly strategic. By using zero-coupon convertible debt, they got $1.15 billion without taking on high-rate interest payments, and crucially, without selling equity at these depressed prices.
But it created a massive short position that's crushing the price.
Yes, but the alternative was selling 81 million shares directly into the market today at a low valuation to fund their growth. Instead, this financing let them grow to 50 EHs, generate that income, and now it gives them the cash runway for the AI transition. Management chose to take a technical short-term headwind in exchange for maximizing scale and retaining equity value. It's an ambitious, calculated risk.
It is a risk, and the market is pricing in the cost of that risk. The fact remains, operational efficiency, no matter how elite, and 16.07 JTH is elite, is a great advantage, but that debt has created a clear mechanical headwind that operational success just can't seem to overcome on its own. The stock is currently a bet on Matt Schultz's ability to pivot to AI, and that is a hypothesis that remains unproven. That justifies the discount.
I, however, remain convinced that the operational reality, the industrial leadership shown by that efficiency, and the virtually irreplaceable 1.45 GW power mode is fundamentally unmatched in the sector. This leadership provides a long-term hedge and ensures profitability, positioning them as an eventual winner. The technical shorting dynamics you described, well, far from being a permanent headwind, I think that is the very mechanism that will make the price appreciation explosive when the AI contracts finally land and that arbitrage pressure unwinds.
What the material clearly presents then is a powerful case study in how financial engineering and market structure can, for a time, completely decouple a stock's performance from its fundamental, on-the-ground operational execution.
And the eventual outcome depends entirely on which force proves stronger in 2026. Industrial efficiency and irreplaceable power assets, or the mechanical pressure created by sophisticated finance. There is clearly much more to explore.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.